US markets. This closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of '87, but it still left traders and investors shell-shocked.
Saw it, didn't you? It was down some.
Why? How come?
I don't know. Bad day.
Bad day for you?
Another one, yeah.
Yeah, I know.
Too many in a row.
The plunge was sparked by a jump in US inflation, the fear a bigger hike in interest rates the only remedy. It was enough to force the Dow Jones down 616 points, a drop of 5.5%. The fragile technology stocks even harder hit, the Nasdaq index in freefall down nearly 10%. It lost a quarter of its value in just 1 week.
Once this body started in motion, it was very, very difficult to put the brakes on. And by 1 o'clock, everyone threw in the towel and said it's a foregone conclusion. These things are going down.
Hello, everyone. Welcome to the weekend edition of Markets Around the World. I'm K2, and we've got some exciting market updates and key data to cover today. We'll break down the latest trends, highlight important levels, and discuss what's been driving the markets. If you're passionate about markets like we are, don't forget to subscribe and stay ahead of the curve. In this episode, we'll explore the major headlines, dive into recent developments, and look at what's ahead. Let's jump right in. A Bank of America analyst sees room for Nvidia Corp. Shares to gain another 40% as a generational opportunity further unfolds. The analyst raised the price objective on Nvidia shares to $190 from $165, with that target implying a 39% upside from Thursday's close. Nvidia's stock is up slightly in Friday morning action. While Nvidia shares are highly regarded on Wall Street, the analyst believes the company's ability to grow free cash flow at a 45% to 50% margin is underappreciated. This is well above the roughly 23% to 25% average for the Magnificent Seven group of large technology companies. Donald Trump's chances of winning another term in the White House have been rising in recent weeks, according to polling averages. And so have the chances that his proposed universal tariffs of up to 20% on most imported goods could be implemented. These potential tariffs would likely have a significant impact on S&P 500 stocks, with certain sectors being more affected than others, analysts say. Barclays analysts estimate that if a Trump administration imposes a 10% tariff on all imports, along with a 60% tax on imports from China, S&P 500 earnings per share could drop by 3.2% in 2025. An additional 1.5% hit could occur if U.S. trading partners respond with retaliatory tariffs. Tech stocks powered Wall Street to a higher close on Friday, while crude prices saw their biggest weekly drop in a month. Investors largely shrugged off mixed earnings and instead focused on strong results from Netflix and policy moves by Beijing aimed at boosting Chinese demand. Meanwhile, gold surged past the $2,700 mark for the first time ever. Gold is having a strong run because of the breadth of uncertainties, said Greg Basuk, CEO of AXS Investments. It's the go-to safe haven, and investors would be wise to diversify their safe haven allocations given the current high level of uncertainty. Global hedge funds ramped up their purchases of U.S. information technology stocks, including semiconductors and hardware, at the fastest pace in 5 months, according to Goldman Sachs on Friday. This surge comes as the third quarter earnings season gets underway. Outside the U.S., contrasting reports from Taiwan semiconductor manufacturing and chip-making equipment supplier ASML Holding sent their shares in opposite directions. Investors now await earnings from semiconductor companies like Advanced Micro Devices and Nvidia, hoping to spot emerging trends in the sector. Now let's dive deeper into the conversation. I want to show you guys more data to really understand the trends we're seeing. Let's begin with the sharp upward momentum in 2024 plus 43.5% could suggest that the S&P 500 has had a strong rally, potentially leading to a momentum exhaustion scenario. Historically, such sharp gains are often followed by corrections, or at least a period of consolidation. Mean reversion trade. Given the high performance this year, this may be an opportunity to consider a mean reversion short trade, betting on a pullback or cooling off in the coming months as the momentum slows. This could be supported by upcoming economic data, changes in Fed policy, or external macro pressures that could shift the market dynamics from growth to risk aversion. Equity put-call ratio hits lowest in over a year. The CBOE equity put-call ratio represents trading activity in bearish put options relative to bullish call options tied to individual equities. Late last week, the index touched 0.44, its lowest level since July 11, 2023, according to Dow Jones market data. In the past, when the ratio has fallen to extreme lows, a pullback has often followed. Every week, the Commodity Futures Trading Commission, CFTC, releases data tracking short and long positions across futures tied to equity indexes, bonds, interest rates, commodities, and currencies. The latest data, through October 8th, reveals that asset managers have maintained a net long position in S&P 500 E-mini futures above 1 million contracts for 4 consecutive weeks. The last time positions were this stretched for such a duration was just before the COVID-19 crash in February 2020. In total, this net long position represents over $306 billion, betting on the continuation of the market rally, according to CME data. Each contract is priced at $50 times the level of the S&P 500, which stood at 5,864.67 at Friday's close. However, keep in mind, these positions are often leveraged, with futures traders typically trading on margin, making them more vulnerable to a potential shakeout if the market takes an unexpected turn. Insider buying has slowed to a crawl, raising concerns among investors. Executives and corporate insiders often receive shares through stock-based compensation plans, but they can also buy and sell their company's stock on the open market in transactions they are required to disclose. According to sentiment traders Jason Gopfert, the number of insiders purchasing shares has recently dropped to levels not seen since September 2021. While insider buying isn't an exact science, it has historically served as a reliable indicator of whether stocks appear cheap or expensive. In summary, corporate insider buying has hit its lowest level since late 2021, signaling potential caution in the market. Valuations are looking stretched, raising concerns for investors. Wall Street professionals utilize various metrics to assess whether stocks are cheap or expensive. One of the most popular methods is comparing the price of the S&P 500 to the expected profits of its constituent companies over the coming year. This comparison is known as the forward price-to-earnings PE ratio. Earlier this week, the forward PE ratio reached its highest level since July 2021, signaling that stocks may be overvalued relative to anticipated earnings. As valuations continue to stretch, investors should proceed with caution. But by another measure, stocks are even more richly valued today than they were in 2021. In fact, based on the price of the S&P 500 relative to revenue figures its member companies are expected to record over the next 12 months, the index has reached its most expensive level since September 2000, right around when the index hit its dot-com peak. A key technical indicator is nearing overbought territory, raising alarms for investors. Technical strategists often rely on price levels of an index or security, rather than delving deeply into fundamental analysis for their investment cues. One of the most widely used indicators has shown that the S&P 500 is approaching overbought territory. The 14-day Relative Strength Index, RSI, reached its highest level since July earlier this week, according to FactSet data. Historically, when this momentum gauge rises above 70, it signals that the market may be looking toppy. As we approach these critical levels, investors should remain vigilant. Are we headed for a lost decade? Goldman Sachs projects that the S&P 500 will deliver just 3% annualized returns over the next 10 years, placing it in the 7th percentile of historical performance since 1930. On a real basis, that translates to only 1% returns after inflation. The more concentrated the market, the higher the risk of minimal returns. What do you think? Does this prediction hold? Stock performance for the week. Apple, AAPL, technology sector, up 3.27%. Microsoft, MSFT, technology sector, up 0.44%. NVIDIA, NVDA, semiconductors sector, up 2.37%. Google, GUG, communication services sector, up 0.32%. Amazon, AMZN, consumer cyclical sector, up 0.09%. ExxonMobil, XOM, energy sector, down 2.91%. Johnson & Johnson, J&J, healthcare sector, up 2.27%. United Health, UNH, healthcare plans, sector, down 4.75%. Visa Fee, financial services sector, up 4.60%. JP Morgan Chase, JPM, financial services sector, up 1.39%. Here's a summary of the major companies reporting earnings for the week starting October 21st. Monday, October 21st, before market open, Lufax, Caspi Docase, Dynex, HBT Financial after market close, SAP, Nucor, Berkeley. Tuesday, October 22nd, before market open, Verizon, GM, 3M after market close, Enphase, Brandywine, Seagate. Wednesday, October 23rd, before market open, Boeing, AT&T, Coca-Cola, NextEra, Energy. After market close, Tesla, Lam Research, IBM, ServiceNow. Thursday, October 24th, before market open, American Airlines, UPS, Southwest after market close, Deckers Brands, Western Digital, Skechers. Friday, October 25th, before market open, New York Community Bancorp, Colgate-Palmolive, Newell Brands. This list features some highly anticipated earnings reports, such as Tesla, Coca-Cola, UPS, and IBM, which could lead to significant market movements. The fear in index now at 75 level. Would you buy stock with this greed level? All right, ladies and gentlemen, that's all for this video. If you found value in the content, please like and subscribe. If you have any questions, feel free to drop them in the comments below, and I'll get back to you as soon as I can. Thank you for watching, and I'll see you all later. Bye for now.